Welcome back. Amid continued macroeconomic uncertainty, our next guest says that high-quality, short-duration bonds offer investors an attractive combination of yield and lower risk. For more, let's bring in Etienne Bordeleau Labrecque. He's Vice President and Portfolio Manager with Ninepoint Partners. Etienne, thanks a lot for coming in. Let's bring the viewers into a conversation you and I were just having before the cameras came on, and that you're paying a lot of attention to a trade deal that's been announced between the United States and Vietnam, and you think this could be a template for other trade deals that get reached, and there's cause for concern here with respect ultimately to U.S. inflation.
Yeah, for sure. So what we heard this morning from President Trump is that he's about to announce a trade deal with Vietnam, whereas American goods going to Vietnam face no tariffs, and Vietnamese goods going to the U.S. face a 20% tariff. And we've seen a similar kind of lopsided deal with the U.K. So if you think about the Europeans, the Japanese, we've been hearing from the Trump administration that they're difficult to deal with. So that means that they're not accepting these kinds of bad terms in terms of a trade deal. So to us, it feels like we've been in the eye of the trade war storm most recently. Markets are back to all-time highs. Credit spreads are extremely tight. And we might talk more about that a bit later.
Yes.
So there's a lot of complacency out there. And I think that rightly so, the Fed's chair, Mr. Powell, is focused on what is this going to mean for inflation going forward. We're going to see more of these lopsided trade deals, whereas Americans still pay the tariffs. Remains to be seen if companies can pass them through or not in price increases, but this is going to hurt for Americans.
In other words, you think stubborn U.S. inflation is possible. Does that mean that the U.S. Fed is less likely to reduce rates?
My view is the Fed either doesn't cut at all because inflation's going to remain too high for too long and the economy remains soft but okay, or they'll cut a lot because all this instability and these essentially it's like a tax hike on Americans, these tariffs is going to drive the economy slower, and then the Fed will have to act and cut more aggressively.
Thus far, 2025 has been a pretty good year in fixed income markets. Do you see this? Do you see a more difficult second half?
It depends where you are. I think the fixed income markets are very large, and there's a lot of different types of instruments that have different sensibilities. We think that the Fed's likely to end up having to cut rates because of the damage inflicted onto the economy there. So you want to be positioned for that. Historically, people think, the Fed's going to cut rate. Let's buy the biggest duration I can. Let's take the most interest rate risk possible to benefit from that. This time around, with fiscal deficits around 7% of GDP and expected to stay there for a long time, and debt in the U.S., federal debt as 120% of GDP, that's where it was after the Second World War.
Yeah.
I think that it's dangerous to take too much duration risk, go out 10, 30 years. I think you want to stay short, benefit from potential rate cuts, and earn more income. The yield curve in the U.S. is still inverted.
In other words, you are concerned about the tax and spending legislation working its way through the U.S. Congress right now, which would expand the U.S. fiscal deficit to well over $3 trillion over the next 10 years.
Yeah, so the fiscal situation is already unsustainable. Everybody seems to agree on that. Even the Fed chair repeatedly said so. You have higher interest costs. And at the same time, this piece of legislation is a massive wealth transfer from the poorest Americans to the richest Americans. The poor Americans are not going to benefit from this tax bill very much. So, and they're already strained. So this is not exactly the kind of legislation you would want to be pushing through. Just look at what's going on in the UK today. I don't know if this was covered on the program, but there was a large increase in government bond yields in the UK today. 30-year bond yields, I think, are up 20 basis points. And this is a lot, simply because investors are starting to wonder if Rachel Reeves, the chancellor, might be on the way out. So the more debt you accumulate, the more fragile your fiscal situation is, the more risky it becomes, and the more likely it is that bond investors lose faith. And you see that kind of very large increase in borrowing rates, which increases the cost of carrying that debt for the government, and it makes things worse.
Okay, you said you wanted to talk more about the very narrow spreads now between sovereign and corporate debt.
Yeah, so just like equities are back at all-time highs, corporate credit spreads, which is essentially the compensation you get for lending to a corporate issuer as opposed to a government bond. So it's the credit premium we expect to lend to riskier companies. Well, it's back to all-time tights as well. So in an environment where we're in the middle of the trade war storm and in the eye of the storm, and we might see more volatility ahead, I think it's prudent to keep some powder dry and to be more defensive in credit. I disagree with your prior commentator that was suggesting to buy high-yield bonds. I think high-yield bonds are priced to perfection. Now is not the time to own them.
You think default risk is there? She minimized default risk. She said the defaults are running at historic low levels, and she expects that trend to continue.
Yeah, actually, they've been rising. So if you look at the data from S&P, from Moody's, defaults in high yield, in levered loans have been rising, and continued high interest rates in the U.S. is putting a strain on these companies. A lot of them were hoping that rates would be going down, but they have not. So they're refinancing at fairly high rates. And in an environment where growth is softening, we saw the latest consumption report in the U.S. last week. We had negative growth in personal consumption in the month of May. That you don't see that very often. So things are slowing, and I think that's where riskier borrowers are more at risk.
Some of the things we've talked about, U.S. trade policy, the U.S. fiscal situation, point to, some people believe, the so-called end of U.S. exceptionalism. Will Canadian assets benefit from that trend?
Well, I think we could, if we get our house in order, if we improve the attractiveness of Canada as a source of investment, as a destination for foreign investment, at the same time as the U.S. is becoming more unstable and more difficult to deal with, there might be benefits for Canada. We can diversify our trade routes. We can use some of these free trade agreements we already have to send some of our critical minerals, LNG. We first saw the first shipment of LNG out of the West Coast today. So if we can do more of that, then we'll see foreign investment come back to Canada in the same way that it was in the past. But the last 10 years, we have not seen that. So we can certainly position ourselves to benefit from that.